Yeah, it's out. So I figured I'd tell you since we're talking about it.
Oh, that's good.
Yeah, isn't that exciting?
Yeah, that's very exciting.
The estimate for earnings per share was $3, and the company earned $3.74. Revenue was 29.6.
Actually, it's the revenue on a managed basis that compares. So that was 30.44.
30.44, yeah.
And that was better than anticipated.
Assets under management up 17%. It's $3 trillion. That's like Larry Fink's laughing. Like that's not assets under management. Return on common equity 18%. So how's that? I don't see Becky, you don't see a forecast for yearly expenses that Stephanie was talking about.
I don't either. But part of that is because I haven't gotten the press release yet.
Yeah, these are all.
The ROTE at 18, that's better than 17. So that's a good number there. Expenses lower than expected. Revenues a little bit better than expected. We know the provision benefits were going to be less this quarter than last quarter. That's probably why they didn't just crush it on the numbers. But that's still a really good number. These are great numbers. Very solid.
Greg, I'd pull you into this conversation, but I don't know if you have the numbers in front of you as well. The question I'd ask you, though, and I think this is always the issue with JPMorgan, they come out strong oftentimes, and they come out ahead of everybody else. And the question is, how much are you supposed to take away from what's happening at JP vis-a-vis all the other banks and, frankly, the rest of corporate America? Or do you put JPMorgan in its own category?
No, I don't put them in their own category by themselves. I do put them in a category of the big integrateds because that strong capital markets, that strong investment banking activity that you're probably looking at right now is what has powered the performance over the last year. Well, look, we expect the net interest margin environment to remain challenged for a quarter or two. I do agree that it is inflecting. We expected loan growth to be anemic, and we should expect that across the set of the integrateds. But we also expect that they're going to talk about robust pipelines in M&A and issuance. We expect them to talk about a still heightened level of trading activity. And so that's been the thing that has powered them through and will continue to power them through until that net interest margin environment becomes more accommodating. And I think that that's going to be the case for all the big six.
Can I tell you guys a few more headlines? Just this is comments from Jamie Dimon. He was talking about the consumer and community banking. The credit card spend was up 26% and card payment rates were stabilized. And that did, he say, contributed to modest card loan growth. However, in the consumer and community banking, the loans were down 2%. He said that reflected continued elevated prepayments in mortgages and the impact of PPP forgiveness that primarily was offset by growth in auto, which was up 12%. Also pointed out that they now have branches in all of the lower 48 states. They're the first bank to have branches doing that, and they are planning to roll out an additional 400 branches in new markets by the end of 2022. Just different than what we had seen from the past from other banks wanting to kind of shrink the number of branches. They are expanding.
Why don't we go to Steph? Steph, can you see these numbers?
Yeah, I can see. Those are great numbers on the card side. The only problem, Andrew, with JPMorgan is it's expensive. It trades at 2 times book. So it's up 33% year to date, right? It's had a good year, and these are good, very good numbers. But I think you get better operating leverage at Morgan Stanley, Bank of America, and Wells Fargo. Those are the 3 I own, in full disclosure. I also think that Citigroup is so cheap, you have to take a look at that one. So it all depends on what you're really looking for, what you want in your financial services exposure. JPMorgan is just right down the fairway, and they have a flawless execution, and the numbers are really good. But I actually think you're going to see even better numbers.
That's my question to you, Steph, which
names.
is sort of what I was alluding to with Greg. You're going to see the other numbers from the banks, from those other banks that you just mentioned soon. Do you look at this and say, we're going to see smashes across the board? Or do you look at this and say, you know what, these guys know how to execute?
Well, they know how to execute for sure. I think Morgan Stanley is a story about diversification and M&A, right? Because they bought Eaton Vance and E-Trade. They're trying to diversify away from the yield curve, which I like very much, and they're buying back $12 billion in stock. And I haven't seen the trading revenues and the investment banking numbers on JPMorgan, but obviously we're going to watch that on Morgan Stanley. Bank of America, if you think rates go higher, this is your play. And Wells Fargo is just a restructuring story with expense saves that I think have upside to it.